Welcome back. Today we're diving deep into HDFC Asset Management Company, or HDFC AMC. It's a major player in India.
Absolutely. And our mission today really is to try and square this circle. You hear two things. Is it this amazing decadal growth story?
Long-term play.
Or is it actually facing a kind of structural profitability crisis? They seem totally at odds.
Okay, let's start with the bull case, the big picture. You almost have to start with the macro context in India, don't you?
You really do. The huge tailwind is what people call the financialization of savings.
Okay, so that's basically wealth shifting, right? Moving out of traditional things.
Exactly, out of physical stuff like gold, like real estate, and flowing into financial assets. Stocks, bonds, mutual funds.
And the potential there is just massive, looking at the numbers. India's assets under management, the AUM, compared to its GDP, is only, what, 15, maybe 17%?
Tiny, compared to the global average, which is closer to like 74%.
74. So that gap represents just this huge multi-decade runway for growth.
It really does. And you see projections, right? We're talking maybe $9.5 trillion in cumulative inflows over the next 10 years into financial assets overall.
$9.5 trillion.
And a big chunk of that, maybe $0.8 trillion, is expected to go into equities and mutual funds specifically.
And what's driving that steady flow? I keep hearing about SIPs.
Systematic investment plans, yes. They're the engine. They really stabilize AUM because it's regular monthly investments.
Like clockwork.
Pretty much. They actually hit a record, I think it was June 2025, 273 billion rupees in a single month. That creates a really sticky, predictable revenue stream for AMCs.
Okay, so the industry tide is definitely rising, but how does that translate specifically to HDFC AMC? Let's talk about their model, this fortress model people mentioned.
Right. Historically, they've been incredibly strong financially. It's an asset-light business, no real heavy capital needs.
Zero debt on the books.
Zero debt. Operating margins often near 80%. And consistently high return on equity, ROE, often over 30%. It's been a profit machine.
And a lot of that comes down to what they manage, right? The product mix.
Precisely. The key is that a big chunk, over 63% of their AUM, is in higher margin equity funds.
Ah, okay. More complex, actively managed funds usually cost more.
Exactly. And that mix results in a very healthy blended yield, around 47 basis points across their whole AUM. They really optimize for profitability.
Okay, but here's the crunch. The paradox we mentioned at the start. That profitable fortress seems to be facing a major threat.
It is, a very immediate one. It's the SEBI consultation paper from October 2025.
SEBI, the regulator.
Right. And they're proposing a pretty fundamental overhaul of industry fees. Specifically, the TER, the total expense ratio.
So the TER, just for everyone listening, that's basically the maximum annual fee a fund house can charge you, the investor, as a percentage of your investment.
That's it. And changing those limits, well, it's the single biggest uncertainty hanging over the industry right now.
And it's not a small tweak they're talking about, is it? What are analysts saying?
Well, the estimates are pretty stark. Depending on exactly how the final rules shake out, analysts see a potential permanent hit to profit before tax, or PBT.
Permanent reduction. How much?
The range is pretty wide, but somewhere between maybe 8% on the low end up to potentially 33%, a third of pre-tax profits potentially gone.
Wow. Okay, that's significant. That really changes the underlying economics.
It absolutely does. It's a potential rebasing of the entire profit model, and it's not the only pressure point.
Right, there's competition too, the rise of passive funds.
Exactly. The second structural risk. Passive investing index funds, ETFs, they've exploded. Passive AUM grew something like 6.4 times in just 6 years.
6.4x. And those funds are much cheaper, right? Lower TERs.
Much cheaper. So as more money flows into passive, it structurally pulls down that high blended yield we talked about. HDFC, AMC basically has to launch its own low-cost products to compete, further pressuring margins.
So you've got regulatory pressure pushing fees down from the top and competitive pressure from low-cost passive pushing them down from the bottom.
That's a good way to put it. It's a squeeze.
Okay, so if we tie these risks together, how does this show up in the forecasts? Are people expecting this margin hit?
Oh, definitely. You can see it clearly in the analyst consensus numbers. Look at the next 5 years. Revenue growth, the top line, is forecast at a healthy 14.4% compound annual growth rate. CAGR.
14.4% revenue growth. Pretty good.
But then look at the bottom line, the earnings growth, the profit after tax, or PAT CAGR. The minimum forecast there is only around 12 to 13%.
Ah, so revenue growing faster than profits. That gap is the margin compression everyone's expecting.
Exactly. It confirms the market fully expects profitability to get squeezed. It's already baked into the numbers.
So if the market already expects only 12-13% earnings growth, what about the valuation? How does that stack up?
Well, that's where it gets challenging. The stock trades at a premium multiple. The trailing 12-month PE, price to earnings, is around 47 times.
47 times earnings for 12-13% growth. That sounds rich, especially with the regulatory sword still hanging there.
It does seem rich. That kind of multiple usually demands much higher growth, or at least much less uncertainty. It's pricing in a level of, well, perfection or stability that just isn't guaranteed right now.
Okay, so summing it up, the verdict seems pretty clear then.
I think so. You have this genuinely world-class growth story unfolding in India. The financialization theme is real, huge potential.
Wow.
But the immediate regulatory risk around TR is massive, and crucially, it's unresolved. We don't know how bad the hit will be yet.
And that risk of a permanent structural derating, a lower profitability profile forever, it just seems too high to justify paying a premium multiple for that 12-13% expected growth.
Agreed. So for anyone thinking about putting new capital to work here, the conclusion really has to be wait and watch. See how the regulations land.
Wait for clarity. Okay, let's leave our listeners with a final thought. You mentioned management making a defensive pivot. What's that about?
Right. So think about this. If your core high-volume mutual fund business is under structural attack on fees, what does it signal when management starts actively investing to, quote, diversify the business footprint?
They're looking elsewhere for profits.
Specifically into areas outside those tier caps. They're building out their alternatives business. We're talking AIFs, alternative investment funds, and PMS, portfolio management services.
Higher fee products for wealthier clients, usually.
Exactly. Bespoke, high fee. So the provocative question for you is, what does it mean when the market leader, with its history of incredible profitability in mutual funds, feels the need to aggressively push into these alternative, less regulated fee structures?
It suggests maybe they see the writing on the wall for easy profits in the traditional mass market fund space.
It certainly signals that the battle for long-term profitability in Indian mutual funds might be getting a lot tougher, something to mull over.
Definitely something to think about. We'll have to leave it there for today.